Now moving on, right here you can see that price opened right here and straight away it went into a ranging profile and from this range just above the key level to generate liquidity. First of all, price generate liquidity or accumulated liquidity above the key level, and then the second sequence is where price purchased liquidity in the form of this manipulation profile, and with that it tested a higher time frame key level and that resulted in the low of the candle being formed, right? That would give you enough confirmation that now the low of the candle has formed and now liquidity could be neutralized and price can expand higher, right? This is the place when you would start looking for your entry setup on the lower time frame after liquidity is generated and the high time frame key level is tested, right? That is where you're going to start looking for an entry on the lower time frame, right? Your objective is to look for an entry right at this time. You're going to stay away from price during the range or ranging profile. After the manipulation profile ends, we can see that we formed the low of the candle and we've purged liquidity. Now the liquidity is at an imbalanced state and now it has to be neutralized, and that occurs in the form of an expansion or distribution. In this case, we've got the higher time frame drawn liquidity above, so we're going to expand higher, right? And with that expansion, we neutralize liquidity until a higher time frame drawn liquidity or key level is reached. When a higher time frame drawn liquidity or key level is reached, the liquidity is finally neutralized, and now we can retrace a bit, and then the candle closes, right? Now the name candle is just a name for this whole sequence, right? This is basically a sequence of moves which happens in a dynamic fashion between two key times, right? For example, we are dealing with a 5 a.m. 4-hour candle. Then we know that this candle forms from 5 a.m. till the end of at 8 a.m., right? We know that this is the time frame or the two timestamps within which a 4-hour 5 a.m. candle forms, right? This 4-hour candle starts at 5 a.m., which is its opening time, and then it closes right at 9 a.m., right? Which is its closing time, right? So basically, open high low close shows us the sequence of the dynamic moves or phases which occurs during these 4 hours, right? And it tells us what actually happens during this time, right? It basically gives us a graphical overview representation of the whole sequences that occurs during this particular time, right? And obviously we know that that's going to be dependent on what the higher time frame framework is saying based on dealing ranges, market profiles, and key levels. Now remember that each time it will tell you a different story, and your job is to dissect and analyze what each candle is trying to tell you, right? And you're gonna tell that based off of combining it with high time frame key levels and dealing ranges, right? And you're gonna see what has price done uh, close to the opening time or close to the closing time, right? Those two things will uh, help you gauge price, right? Sometimes it's gonna form a candle with a huge wick, and when you use this exact framework, you're gonna know you're gonna be able to know that what had happened on the lower time frame, which led the markets to form this exact candle, this exact type of candle, right? Moving on, here we're gonna discuss a classic sell candle or a bearish expansion candle, right? It has got all the same details and intricacies as the classic buy candle with just a few differences, right? So right here again, you can see the opening price acts as a range to generate or accumulate liquidity below a key level, and then price manipulates above to purge the liquidity to test a higher time frame key level and form the high of the candle, right? And price then neutralize the liquidity by expanding and distributing lower to reach the higher time frame drawn liquidity and test an opposing key level. And with that, it forms the low of the candle and then it retraces above a bit, close to the closing time, and then the candle closes, which acts as a reset for the whole cycle. Now moving on, right here you can see the price right away started with a ranging profile from the opening time, and it generated liquidity below the key level. After that, we took out the range and the whole liquidity it generated, and we had a manipulation profile. After that manipulation profile, we have now imbalance in price, and price is finally formed. They have the candle, and now we have to rebalance the liquidity and make sure that the market becomes rebalanced again. And for that, we know that it's going to get rebalanced by neutralizing liquidity, and which happens through an expansion or distribution of price lower, right? Which is also known as a range expansion lower. And then with that range expansion, we form the low of the candle, and the candle closes, resetting the whole cycle. Now we have discussed all of the intricacies and details regarding open, high, low, close, right? Now we're going to move on to the next part of the chapter, which will deal with how you can integrate this concept with the other ones, and how we're going to use it logically in a proper framework, right? So moving on, in this slide we're going to discuss how we're going to accurately use open, high, low, close, or open, low, high, close in a logical manner, right? Here are some important points you must remember. First of all, the open of the candle most of the time starts with a range. We've already discussed this before, but let me say it again. The open always and most of the time is a ranging profile which generates and accumulates liquidity, and for that reason you must stay away from charts at this particular time. Second point is that the high or the low of the candle, which is formed during the manipulation profile or when liquidity is being purged, that high or low is always formed at a higher time frame key level, right? And that manipulation profile always happens to test a higher time frame key level, right? Next one is that the expansion occurs towards the higher time frame drawn liquidity or an opposing higher time frame key level. And as I said before, you're gonna make sure that you already have the higher time frame framework where you've already decided where the drawn liquidity is and what is your bias going to be for the day or the week, and then based off of that you're gonna break down this whole candle that you're gonna be working with, right? And then last but not least, the close of the candle, just as I said before, acts as a reset for price to reset the whole cycle. These are some important points you must note, right? Now let's move over and let's see some examples of it. First of all, right here we've got a typical example of a classic buy candle or a classic expansion candle. You can see the lower time frame price section of this candle, and you can clearly see we almost immediately started off with a ranging profile, and for the first quarter of the candle it basically ranged without doing anything significant, right? So you would have stayed away from the charts at this time. That was the period of generating a generation of liquidity for this particular candle. Then you can see that price purged below the low, right? And the range it formed, uh, price purged below it and had a small manipulation profile where it purged the liquidity it generated before. Now with this purge below the lows, there could have been a key level which price tested, right? And price formed the low there, right? And after that, price had to neutralize the liquidity, and which happened by price expanding above and distributing higher, with which price formed the high of the candle, right? Now remember, this candle could be on any single time frame, right? Literally it could be on the 1 minute candle, right? It could be a 1 minute candle, and still it'll follow the same rules and it'll have the same sequences, because we know that these concepts are all fractal, right? So the time frame doesn't matter. You could replicate and use this sequence for any candle or any time frame and any asset, right? But if you want optimal performance, then you're going to use time frame selection and time frame alignment to determine your time frames and to use these concepts in the most logical and refined way possible. Second one we got right here is the classic down close candle or classic sell candle. And in this one again we've got the same framework. I started off with a range, then it purged the range and purged the liquidity by having the manipulation profile, and then it formed the high there, and then it expanded and distributed lower in a classic fashion, forming the low and then closing above to reset everything. Here we got another one. We're gonna combining it with the CRT, right? Now, as I said before, there always be a key level below or above these candles, right? So remember, when I'm showing you these examples, the low or the high is always formed at a higher time frame key level, right? So you must remember that. You must make sure that there is a higher time frame key level which can support price. You can see the first candle is a classic sell candle, right? And that sell candle is now going to be used as CRT. And you can see the next candle opened right away, taking out a CRT and testing a higher time frame key level, right? Right here you can see that this is a unique scenario because the candle right away tested a higher time frame key level and did not generate any liquidity for the next one, but you can say it, you can see that it did purge liquidity below the other candle low or the CRT low, right? So now what price is going to do is to neutralize the liquidity by expanding above, because we produce an imbalance. We produce an imbalance by purging liquidity below the CRT low, and the CRT acted as a generation of liquidity, right? And then it purged it right away as soon as the next candle opened. And now the most likely scenario for price is to expand above and rebalance the range to form the high of the candle, right? And then as soon as the high is formed at a key level, price retraces a bit and it resets the whole cycle, closing the candle, right? These were some simple examples regarding open high low close or open low high close. Now we're going to move on to the most important part of this chapter, which is building and developing anticipatory skills, right? So this part of the chapter will deal with how you're going to use open high low close to refine and develop your anticipatory skills, and how you're going to make sure that you only trade the high probability conditions and avoid the lower probability ones, right? That's what anticipation is all about. Approaching price only when the time is right and when the price is right, right? And if neither of them or either one of them isn't right, then you're going to sit out and wait. You're going to stay risk off, right? That's going to be a definite protocol for you. We're going to see how we're going to combine this particular concept with key levels to accurately anticipate price action both on the higher time frame and lower time frame. We're going to learn how to accurately and precisely integrate market profiles, right? We're going to see how it is used to probe order flow or measure order flow on the lower time frame. And then last but not least, it will be used as a filter for you. And I'm going to show you all of these, and I'm going to explain all of these to you on some charts example that I've prepared for you. So it's better for you to understand it properly, right? It's going to be better for you to understand it if I'm going to explain this on charts, right? So let's get into the examples. Right here you can see that we've got these price sections, right? On the left we've got the higher time frame price section, on which we'll discuss the open high low close, and we're gonna break down this candle. And to the right we have the lower time frame price section, and we're gonna see how both of them resonate with each other, and I'm gonna show you how they both relate to each other and how you could use open high low close to assist you in your analysis while combining it with higher time frame key levels. So in this example, I'll just use key levels to explain these, but you need to remember that you have to combine and integrate all of the other concepts too, and use them in your analysis as well, right? This will just build your fundamental understanding, so that's why I'm only using key levels, right? But you're gonna make sure that whenever you are doing your analysis, you have to integrate the other concepts as well, right? Just for the sake of the video, I'm only using key levels. So right here you can see that we've got this higher time frame price action, and you can see price opened right here, and till now it hasn't done anything yet, right? Now through my analysis, let's say I've determined that my drawn liquidity is this daily FEG's low. Now with that framework, let's see how I use open high low close to dissect and break down this particular candle on the higher time frame, and how can I make sure that I only enter in the high probability condition and avoid the lower ones, right? And how can I catch expansion with the help of this concept, right? You're going to see that in just a minute. So first of all, is always priced after open, we're going to expect price to generate liquidity in the form of a ranging profile or a range, right? That's what we're going to expect. So let's see what happens. Right here you can see that first of all we formed a ranging profile and we generated liquidity there, right? And then after that generation of liquidity, we had a manipulation profile, and with that we took out the liquidity that we had generated and we purged it, right? You can see right here, this is where the liquidity was being generated in the form of this range being formed, and right here this is where it was purged, right? Now let's combine it with key levels and let's see what we've got. Now with key levels, you can see it becomes a lot cleaner. You can see that first we range below the key level and then we manipulate it above that range, and with that manipulation, just as I had mentioned it before multiple times, we tested a higher time frame key level in the form of this CRT high. And with that, we also successfully formed the high of this higher time frame candle. So now you can see we first generated liquidity, then we purge it, we form the high, and now we know that our higher time frame liquidity is lower, and now the liquidity has to be neutralized, and we know that that's going to happen by price having an expansion or distributing lower, right? And with that distribution lower is going to form the low of the higher time frame candle, right? That's what's going to happen. So your job would be to enter right now and use an entry model to enter right here, and you're going to be able to successfully catch the expansions on the lower time frame. Now let's see what happens. You can see right here we neutralize the liquidity by distributing and expanding lower, and we rebalance the whole range with this range expansion, and we successfully found the low of the higher time frame candle, right? With this move, and we reach the higher time frame down liquidity. Now you can see we've successfully reached the higher time frame down liquidity. So now we're gonna expect price to now retrace a bit till the closing times, and then the candle is gonna close and it's gonna have a reset. So moving on, right here you can see price retraced above because it reached the high time frame down liquidity, and that acts as a support for price to close above, right? And price closed above and closed the candle and resetted the whole cycle. Now let's look at another example right here. Again, we've got these two price action. On the left is the higher time frame and lower time frame to the right. And now we're going to see how we could use open high low close or open low high close here to assist us in our analysis and helps us in building our anticipatory skills, right? And how we could anticipate the correct phases or sequence of price, right? And how we can use it as a filter to filter out lower probability conditions. So right here, first of all, as I said before, you're going to use all your different concepts to first of all determine your high time frame down liquidity, and only then you're going to use this particular concepts to assist you with probing the order flow on the lower time frame and breaking down the high time frame candle. So that through the help of all the high time frame analysis, I've determined the down liquidity is higher. And now we're going to use open high low close to help us probe the order flow on the lower time frame, and it's going to help us break down this higher time frame candle that we've got right here. Now let's see what happens at the opening time. First of all, you can see we straight away went into a ranging profile, and that's exactly we almost always do pretty much, right? And with this ranging profile, we successfully generated liquidity above the key level, and now we're going to see what key levels we've got on the higher time frame that we can match with the lower time frame price action, where price can successfully form the low of the higher time frame candle, and and then we can expand above. Right here you can see that we've got this higher time frame key level in the form of this order block, right? So the framework is that first of all we generated liquidity from the opening price, and now we've got this higher time frame key level where price could have its manipulation profile to purge the liquidity and form the low of the candle, right? You're going to stay away from price throughout all this price action, and you're only going to approach it once price forms the low of the candle and once it tests the high time frame key level, and then it shows you a change in the state of delivery, right? You're gonna only engage with price when that happens. Now let's see what happened next. Right here you can see we successfully tested the high time frame key level by having this manipulation profile and patching the liquidity that we generated earlier. Now we can engage with price and approach it and potentially trade it on the lower time frame with our entry models or entry setups. Let's see what happens. You can see price neutralize the liquidity by distributing and expanding higher, and it rebalanced the range by having this range expansion, and then it closed, resetting the whole cycle. Here we got another example that we're going to use to see how open, high, low, close could have helped us in our anticipation of price. First of all, let's see what happens and what sort of range price forms and where does it generate liquidity. Right here you can see that the first quarter of this candle price arranged and formed a ranging profile. Now let's combine key levels and let's see if we have any key levels where price can form its high of the candle and then potentially expand lower. Right here you can see that we've got this higher time frame key level in the form of this order block, and what price did is first of all it formed a range and generated liquidity, and then it purged above the range to test the higher time frame key level and purge the liquidity. Now the only possible outcome for price is to neutralize the liquidity by having a range expansion lower and rebalancing a candle to form the low of the candle. Right, let's see what it does. And there it is, price expanded lower forming its high, and here finally formed its low and closed, and then it closed the candle and resetted the whole cycle. Right, you can see more often than not before closing it always has a small retracement before it closes, right, and with that retracement it forms the low of the wick of the candle. Moving on to the next slide, here are some important points regarding open, high, low, close that you must remember and note down. First one is an important one. Don't trade right away after the open of the candle, because we know that it always usually is a ranging profile, so it's better to not engage. Always wait for the high or the low of the candle to form at a higher time frame key level before trading it, right? This will ensure that you don't get caught up on the wrong side of the markets. When you only trade after the high or the low is formed, that will make sure you only take part in the expansions of the candle, and you can make sure that you catch the expansion and you'll be able to easily and more accurately exploit it on the lower time frame. You would never want to take part while liquidity is being generated, because you would end up to be the liquidity yourself, right? And you wouldn't want that. Similarly, you would only take part during the manipulation or purging of the liquidity only if you are an advanced trader and you have a proper entry model for it, right? And you know the ins and outs of your model. Your job as a beginner or intermediate student should be to only take part when liquidity is being neutralized, and if you're having an expansion or distribution, that will ensure that you catch the most explosive and expansive moves, right? Following the above two rules will make sure that you only catch high probability conditions, right? That's true. Always partial and get out completely as soon as an opposing key level is reached or the higher target liquidity is met. That's pretty obvious and clear, right? So these were some points regarding open, high, low, close that you must remember when trading it or using it in your analysis, right?